Starting, all attendees are in listen-only mode.
So welcome everybody to the next installment of the Teach in Tuesday webinar series. I'm Zach Miller. I'm a partner here at OurCrowd. We do these every other Tuesday or just thereabouts. We try to do 2 of these sessions a month. It's an opportunity for us to both educate and communicate with our community. We address sectorial issues in terms of investing strategy. We bring in experts to talk about different types of technologies. We do a lot of different events here that are generated by the community that we have to help educate, to help further the conversation. Again, I'm Zach Miller. I typically host these things. I'm the head of the investor community. For those of you listening that are accredited investors and have signed up at the OurCrowd website, we will be rolling out more and more community level activities for you. We have a lot in the hopper right now. We'll be happy to tell you more about those, but keep a lookout for some announcements in the near future. Tonight's a very special event for us. We're introducing Anthony DeChellis, who recently joined OurCrowd as president. Anthony has a very long and storied history working on Wall Street, working as managing large organizations, some of the world's leading asset managers. Anthony has made the jump from traditional financial services to OurCrowd. That's a big part of the story that you'll hear tonight. But before I turn it over to Anthony, just a little bit about logistics. We are recording this session, so typically when we do these sessions, people ask me for the slides and a recording. We'll have an email out to you tomorrow with a link to the slides as well as a link to the video where you can review this or share this with your colleagues or your friends and family. You'll have the opportunity as well to ask questions. If you look at your GoToWebinar control panel, there's a questions section. Submit those to me. The logistics are as such. Anthony will speak for about 40 minutes, so we'll leave about 20 minutes at the end for questions and answers. Those could be OurCrowd directed questions. They could be questions about, in general, where financial services are headed, or about Anthony in particular. So we'd love to hear those. Send those through to me. I'll ask those out loud at the end. Without further ado, let me introduce Anthony DeChellis. Anthony.
Thank you, Zach. I appreciate that, and welcome everyone. Good evening, good afternoon, wherever this webinar finds you. I'm very excited to be able to address all of you and talk about a topic that's very interesting to me and very interesting to, I know, our team, and that is the changing relationship between investors and investments. And it's not just investments; it's the firms that provide those investments and how they're going to do that on a go-forward basis. I thought what I would do is maybe just give a little perspective. As Zach said, I've spent the last 30 years on Wall Street, only working for the bulge bracket firms. I think I have a pretty good idea of what investors look for and for what entrepreneurs look for as well, those entrepreneurs who will increasingly be funding through sites like OurCrowd. I thought I'd talk a little bit about where the industry, I think, currently is and what the opportunities for investors are, and probably most interesting to you, is where maybe the industry is going and what that's actually gonna mean for you. Hopefully, I can move this slide forward here. Tamara, if you can help me. There we go. So maybe we'll have a little fun first, and we'll talk about sort of where the industry came from. I'm sure everybody recognizes the scene from the now famous movie Wolf of Wall Street. What this really is, aimed at exemplifying is sort of, the industry when it started, compared to what we offer today, was not a very sophisticated or complex system. I mean, essentially, the business model of the 1970s and even into the 1980s is that a lot of the wirehouses offered information and offered access to capital markets, and that in itself was a business model. Along came Mr. Schwab and said, well, we can do that not only at a lower cost, but even eventually free. And so the game then became we all have sort of access to the capital markets, we all have access to information. It's then who can do the most with that information, except there was a little imbalance because some people were getting information ahead of others. And so in 2000, under the Reg FD, everybody had to get information at the same time. I spent a lot of time talking about this topic, and people are often amazed to learn that even insider trading in markets like Europe were only outlawed in the last couple of decades. So this idea of everybody getting the information at the same time was, a rather, novel, concept in some markets. And what you saw, and those of you who may have read Flash Boys, is okay, if we're all going to get the information at the same time, then we've got to be particularly skilled maybe at what that information is going to mean, or maybe we need to find some other advantage. And I know, Flash Boys is let's see if we can just act on the information faster. And that's when we saw the advent of high-speed trading, and we all know kind of where that led us. And so we're now in a situation where firms are increasingly competing to add value to clients. And it's happening at a time where clients are also very, very willing to take matters into their own hands. So clients no longer, want to sort of have a passive role or just sort of be told what to do. They want to be engaged. They want to be involved. And the competitive landscape is changing in that some firms are beginning to embrace this, allowing clients to be more active in managing their accounts and in directing their accounts. Now, I want to be clear, none of what I'm saying is going to predict sort of a 100% move one way or another. You're going to still have traditional, firms that are taking discretion for clients, that are managing their affairs, and that's for a couple of reasons. There's some clients who absolutely want that. Maybe they feel that the value they're receiving warrants the relationship and what they're paying for that relationship. Others may just not have the time. So it's not that we're going to have one type of model or another. We're going to continue to have multiple models, particularly because most of the wealth that currently exists in place, major developed countries, are in the hands of people that are over the age of 65, and they're less apt to change their behavior. But we know not only the millennials, but the generation above the millennials as well is changing their behavior pretty dramatically, and the stakes are high. If we look at just the investable wealth, it's estimated to be $64.3 trillion. If you look at the major markets outlined here, the global wealth, last I saw it, estimated, not just in sort of investable wealth, is somewhere around $300 trillion. It's 81.5 trillion in the United States alone. So, it's obviously a very important industry. It gets bigger every single year, and what's of particular note is that how this money is being managed is starting to change. So 57% of high net worths consider most of their current wealth management relationship to be digital, and it's estimated that that'll go to about 64% in 5 years. And again, going back to what I originally said is that how people invest and what it means for you, I think, is going to be increasingly dramatic. And so what we're going to talk about today is a little bit about how I think capital currently flows and how it's going to flow in the future. And it'll really kind of probably make obvious to you why I decided to join OurCrowd, and particularly become a part of a different vehicle for funding opportunity, for funding innovation, and for frankly making opportunities available to investors in a different way. Now, the banks aren't completely caught off guard by this. You've seen various big banks trying to respond. Citibank is trying to ride the wave of the new Apple Watch and launch a new app and kind of compete with some of the digital players, some of the robo-advisors, some of the more direct channels. Credit Suisse has also announced in Asia that they're going to have more of a robo-wealth manager for those who want to engage the bank more directly, and frankly for those investors who want to engage on their own time. The problem is that the financial services industry is very ripe for disruption because of what we've experienced over the last 5 to 7 years. The financial crisis is still very ripe in people's minds. They saw an unfair relationship, perhaps between the banks and the taxpayers. Let's talk about that, a little bit. I think that one of the things that we're going to see an adjustment to is the relationship between banks, between investment firms and clients. I think it got a little bit lost as to why these places existed. They exist to look out for the best interests of clients. They exist, to help fuel economic growth. And what we started to see was a lot of proprietary trading. We started to see a lot of the banks, particularly the investment banks, focus on their own proprietary books, their own internal trading, and clients in some instances became sort of a secondary business. I mean, if you think about it, deposits, went into a bank, a large bank. Those deposits are normally, earmarked to be lent out again. But sometimes those deposits, and often those deposits, were lent to investment banks who were part of the same organization, who then levered them up. Sometimes they made great returns, sometimes they didn't, as we saw in the financial crisis. When they made great returns, those returns didn't necessarily flow to the depositors. And then, of course, when there was a problem, the taxpayers got left holding the bag. And so that's been a lot of what the regulatory focus has been, and it's part of what kind of prompted the Jobs Act that we saw in 2012, because banks weren't lending out enough money or fast enough as the government had hoped. And so in came the Obama Jobs Act in 2012. It's taken some time to write, the details of this act, but essentially what it's going to allow is for investment into particularly small companies to be a lot less arduous a process, and to make the opportunity for investing in those companies a much more democratic process, because it's no longer going to be the case that if you have a great idea or you've come up with an innovative concept, that you've got to go to where the money already exists, that you've got to go to either a large private equity shop or a large VC or an ultra high net worth investor or a pension plan. You're going to have people who are inclined to do so, are going to be able to have access to these opportunities, and are going to be able to help identify whether or not these are viable opportunities. Now, when the Obama Jobs Act first came out, it was, our model included in this was limited really to accredited investors, and that was, Title II of the Obama Jobs Act. Title III contemplated letting non-accredited investors invest as well. And for those of you who aren't familiar with accredited or non-accredited, accredited just simply means that you make at least $200,000 a year and you have at least $1 million net worth. Non-accredited investors fall below that definition, and that was until last week. That had not yet been defined what the rules would be for non-accredited investors. And I think a lot of folks got surprised last week because the SEC provided a lot more latitude for non-accredited investors than was anticipated. They did a couple things in my mind without going through the 436-page report they issued. Number one, they're going to allow funding up to $50 million, and they're also going to allow non-accredited investors to self-declare their status, which means that they will declare on each investment whether or not it's more than 10% of their net worth or more than 10% of their income. As long as it's not more than 10% of their net worth or not more than 10% of their income for that single investment, they are going to be allowed to invest in whatever that opportunity may be before them. So this is going to substantially, change the game for not only companies being able to fund, but for opportunities that are made available to the average client. Now, there's not going to be it's not going to be without restriction. For those of you who are getting nervous, there are provisions to the crowdfunding crowdfunding rules. There are general solicitation guidelines. There are bad actor provisions, so anyone who's had a bad history, particularly in the securities business, is not going to be able to participate, and there is going to be an accreditation process, again, even though it's a self-accreditation or a self-declaration for the non-accredited investors. So where does this sort of leave firms like OurCrowd, and where does this leave investors like you, and how you should sort of think about this going forward? The first thing for firms like ours, what we have to consider is where the trends are heading, and whether or not particularly our model is equipped to provide people what it is we believe they're looking for. And what do we think clients are looking for these days, whether it's with their wealth managers or whether it's with any sort of individual investment provider, is they want to be informed, but they want to be more than informed, right? They want to be able to engage in that decision, and they want to be able to participate in deciding on a transaction, and certainly being made aware of that transaction almost instantly. So people just don't want to passively turn over whether it be their pension plan or whether it be their savings accounts. They want to understand more about what's going on. They want to engage in the process, and they want to be able to make decisions about the transaction. Now, this isn't a new idea. There's about 248 companies that we can identify that have developed to provide everything from lending to personal finance, payments, remittances. There are lots of players out there who are trying to get the attention of both high net worth and average investors. As we've looked at before, the stakes are high. It's a $64 trillion asset pool, and so clearly the revenues available to the financial services industry are significant, which is why you're seeing these type of companies pop up. And what we're going to talk about is that all these companies aren't created equal, and we're going to try to give you some guidance as you look at. We talked about specifically crowdfunding. It can get a little dizzying to look at all of the new firms popping up in different categories. Which ones may be appropriate for you, which ones may not be appropriate for you, and how do you decide, which one of these firms should you engage, or maybe stay away from. And so I'm going to try to help you think about kind of, when you're thinking about investment opportunities and where you should search for those investment opportunities, maybe some of the things that you want to consider. So let's just talk about investing for a moment. It's no secret that asset managers have had a harder and harder time trying to beat the indexes. And I'm going to show you an article, or headline from an article in a couple of slides that many of you may have seen in the New York Times, which basically talked about the fact that only two mutual fund companies had beat the S&P 500. I think it was in the last 5 years. And so people are increasingly coming to the idea that maybe passive with lower fees is a good way to go. So non-active management. But what's interesting is at the same time, crowdfunding is growing. And let me tell you the way I see this as someone who's been in the business a long time. This is kind of a barbell approach where people are saying, and not start talking about betas and alphas, but very simplistically, beta, is essentially what the market return will give you at the market's risk, and alpha is what you can sort of generate above that. And the way I view this is that ETFs are increasingly seen by investors as I'm going to get my basic exposure to the market, and I'm going to get sort of my beta exposure through things like ETFs, through things like indexes, or more passive. But in order to generate alpha, I'm going to increasingly have to look to alternative asset classes. And by alternative asset classes, I mean things like real estate, private equity, and venture capital. And what you've seen is that crowdfunding, I think it's one of the reasons that crowdfunding is exploding, besides the other things we talked about, the empowerment that people like having in the decision. But I think that it's exploding because people think they have to take the search for alpha into their own hands. And you can see that crowdfunding has been doubling every year, and the World Bank estimates that it'll be $95 billion by 2025. And we already have a great sort of example of investors wanting to go out there and find opportunities on their own in Lending Club. I mean, this is the classic, hockey stick. As you know, Lending Club is peer-to-peer. It started out that way, and now what we've seen is that because the opportunities that you can find on Lending Club are actually pretty good, institutional investors are becoming bigger and bigger buyers. I think, in fact, they are the biggest buyers now on the Lending Club platform. So $4 billion alone, was transacted in underwritings on their platform last year, right? Which is 4 times what they did in 2012. And I think, whether it's Lending Club or Prosper or just the lending platforms. In general, I think they're a good proxy for what you're going to see happen in equity, finance. So let's talk about the opportunity to find companies and whether or not that makes sense, kind of on your own, and how maybe you should be thinking about this for your own portfolio going forward. Earlier this morning, I had a conversation with a friend of mine who sits on an endowment board with me, and we were talking about the allocation to private equity in the endowment's portfolio and whether or not it should be more or less. And the conversation we got into essentially was, look, increasingly you're going to have to look for opportunities sooner than we did before. And what do I mean by that? Let's use Uber as an example. Uber and Microsoft. Uber is already estimated to be a $44 billion company, and it hasn't gone public yet. If you waited for sort of Uber to go public, and I'm not saying you couldn't make money on Uber after it went public, but a lot of the opportunity you had as an investor is happening pre-IPO. If you compare it to Microsoft, it would be when Microsoft went public. Microsoft realized most of its value after it went public, and I think this is going to be increasingly the case. I think what this means is that because of the advances in technology, because of the dissemination of information now is so broad, and not just on public companies, that people are going to be increasingly more comfortable with making the type of investments and making the type of decisions that they're making, as evidenced by an Uber. There are more and more exchanges, popping up for trading private capital. I think this is going to become, the norm, not the exception. I think that within 10 years, this whole idea that whether private equity or VC being such a stretch of an asset class and only for the big investors or pension funds is just going to be gone. I think it's going to be a normal way to invest. I think that as information becomes not only more readily available, but as people are able to act on that information more quickly, markets do become more efficient. And as this article talked about, is the New York Times answered their own question: how many mutual funds routinely route the market? 0. And I think where this is sort of going to lead is to, whether you're an individual investor, whether you're a professional manager for, investment manager for clients, you're going to have to rethink kind of where you find sources of alpha. And my opinion is that people are going to increasingly find those in the private capital markets, in the private equity markets, and in asset classes like venture capital. And we've seen that I think one of the reasons that there has been such quick adoption for investing in companies online is not just the engagement part, not just the excitement of being a part of something that's new and something that's just starting. And I think it's a realization that this is an opportunity to make money. But now we have to talk a little bit about the risks, because anyone who knows about alternative asset classes would very quickly point out to you that, wait a second, alternative asset classes, particularly if we're talking about private equity or venture capital, have some drawbacks that you need to understand. And first thing they would probably point out is the illiquidity, and so that's why there's a premium, because the asset class is illiquid, and it's been very hard to get information as quickly as you certainly can get on public companies, and that's part of the reason that drives this huge dispersion in performance. So if you're wondering what this chart means, it just means that who manages the money for you, or who makes the private equity decisions or venture capital decisions for you, really matters. Because in this case, the difference between the bottom decile and the top decile is like minus 25% to plus 40%. And so people who might be detractors from the early days of whether it be private equity or venture capital getting funded online would say, well, the small investors are going to wind up in that bottom decile. The good deals aren't going to be made available, and so therefore you're not even going to be able to get the average return in private equity or VC, and you're going to wind up in that bottom category. Now, I can tell you, if I believed that was the case, I wouldn't be sitting here talking to you. I wouldn't have joined OurCrowd, because I had two questions I needed a yes answer to before I decided to do this and become the president of OurCrowd. And the first one was, would this way of investing truly be better for investors? And would it truly be a better process for those entrepreneurs who are trying to fund their companies? And I obviously concluded yes to both of those questions. And a key part of being able to answer yes to the question is I had to look down kind of what drives returns in venture capital or private equity. I mean, we all know that, similar to sort of beta, there's the asset class driver, right? And, what's the general capital markets environment? What's the general pace of innovation for that time period? And how much money are you competing with, for VC? And then, what drives a specific manager's performance is the ability to identify emerging innovations, access to attractive deals, and the ability to create value through the active involvement in portfolio companies. So let's take those three, that are sort of the added value. Can the crowdfunding or crowdsourcing of new venture ideas compete in these arenas? So first of all, the ability to identify emerging innovations. I think the crowd is incredibly powerful there. We see incredible deal flow at a firm like OurCrowd. Somewhere between 200 and 300 opportunities a month, come through the firm. We end up picking, somewhere around 3 or 4 of those to fund, and there's a whole formal sifting process, obviously, for us to get to that point. So I think being able to identify not just opportunities, in a specific geography, but really opportunities around the world is going to be an advantage for platforms like ours. Many of you may be aware of this, but if we just take a market like the United States, there's really 6 states, that participate, have large venture capital businesses, and it's interesting to note that if you look at those venture capital firms located in those states, they tend to make investments within 100 miles of their office, which to me begs the question: is that really where all the opportunities really all lie, within 100 miles of those offices? I think there's probably opportunities outside that, and we're obviously seeing that through the deals that our platform is able to attract. And will you have access to attractive deals? I think we'll have access to not only the ones that our platform can generate, but I think that, and we just had this example where an entrepreneur wanted OurCrowd involved because of the exposure they would get on our platform to the crowd, because they were in a consumer retail business, and for them that was going to be particularly important. So even though they were being led by a larger traditional VC, they asked that VC to come to us and get them on our platform. We're currently evaluating the deal. I'm not sure we're going to do it, but I found it interesting that the entrepreneur wanted the deal to be on OurCrowd. And then the ability to create value through active involvement in the portfolio company. What we've already seen is that companies that come on to OurCrowd, besides being able to network with the other companies, the other portfolio companies, are able to engage the crowd either from a client-vendor relationship or from an advisory, sort of a mentor relationship with people who have a background or experience in that business. And so I don't think it's going to be the case if I go back and say, well, it's going to give smaller investors access to an asset class they didn't have access to before, but they're probably not going to be able to achieve the same returns, or certainly the returns of the better managers. I wouldn't be sitting here if I thought that was the case. I think we can absolutely compete in all of these areas that drive value. So let's look at crowdfunding and where it sits today. If you haven't seen the Goldman Sachs report and you're really interested in crowdfunding, I would highly recommend that you go out and get it. It was put out 2 weeks ago. It's called the Future of Finance, and it's part 3, the socialization of finance. And we took this slide from them. It talks about the $4 trillion opportunity created by the socialization of finance, but it talks particularly about the $1.2 trillion immediately addressable, and in particular interest to us is the $75 billion opportunity currently available in the VC and angel space. Now, what's interesting about the $57 billion, going back to the point I just made before about is the $57 billion going to be invested? If some of it is invested on platforms like OurCrowd, will the funds be invested well? And what we're seeing is not only are investors willing to take their own decisions and act on platforms like Lending Club, what we're increasingly seeing is that the crowd is getting smarter and smarter and starting to work together. This slide is taken from a company called, or a site called Estimize. And if you're not familiar with it, this is basically a firm that allows people to come in and weigh in on earnings estimates, and you'll see the company here is Apple. And so for the crowd, basically a very diverse crowd from all over the world, from different walks of life, not just from financial services, who weigh in on future earnings releases. And what's been really interesting about it is not only is this sort of a neat thing for people to do, but the crowd has actually been outperforming the Wall Street analysts. They've been more accurate 70% of the time in the forecast. And so if you have the crowd coming together that can move faster, identify opportunities faster, and work together to make better decisions, this starts to be a really compelling model. And frankly, it's a model that we've embraced at OurCrowd that I'm going to talk to you about a little bit more in coming slides about specifically what our model is, what exists today, and really where we plan to take it. And what's interesting about this, this whole crowdfunding phenomenon, this crowdsourcing phenomenon, is it's not just a U.S.-based trend. We're starting to see it all over the world. Obviously, Europe and the United States are the first movers. But why is this important? Well, it's important for the same reason that global markets are important. If you have this level of participation, if you have this many investors coming in, then markets, by definition, should get increasingly more efficient. Now, for those of you in the asset management business, you'll say, well, if we're gonna squeeze, if we're gonna make markets more efficient, we're gonna probably squeeze out some of the return. I think that's true. I think if you're, investing in private equity, if you're investing in venture capital, other than the occasional unicorn you're gonna find, you probably should expect that returns in these asset classes are probably going to be lower. But I think the good news is that relative to the public equity markets, they're still going to outperform. And in fact, in some ways, I would even go so far as to say that these asset classes, because of the new ability we have to disseminate information quickly, to to analyze that information and to act on that information, in some ways, these markets are going to resemble public markets in a lot of ways. And so I get back to where I started: is if you accept that and if you think about that, and you're looking at your portfolio, and you're looking at where you're going to generate alpha on a go forward basis, you almost have to have an allocation to this asset class, or you're not going to be able to I think, compete from a performance standpoint if you're a professional, and you're not going to be able to achieve your goals just from an individual investor standpoint, whether you're planning for retirement or whatever your savings are earmarked for. And I think the fact that this is a global phenomenon is going to move us in this direction even faster. And so when you go out there and you look at the various platforms, you're going to find that all platforms aren't the same. I mean, there are sort of more free market platforms that basically say, look, let the put the opportunity up there and let the crowd decide whether it's a good opportunity or not a great opportunity. We're not going to really be involved in the due diligence of those opportunities, and just sort of let the chips fall where they may. OurCrowd has a different approach and a different philosophy. We believe that we should help facilitate, be part of that diligence, and help facilitate the intelligence of the crowd in a meaningful way. And there's a couple ways we can do that, and we already do that with networks we have. I'll use the example of a medical device company. If we have a new company coming to OurCrowd, and it's a sophisticated new technology, let's say in the area of medical devices, there's a network of people outside of sort of OurCrowd that are advisors to the firm or mentors to the firm, who will look at individual opportunities and help us render an opinion as to whether or not it's viable, whether or not there are competing technologies out there that would render their efforts meaningless if you weren't aware of those other technologies. So we do have a network. Our plan is to make that much broader, much more global, and frankly a much faster acting network, where you can literally have, whether it be the crowd broadly, if it's something like a consumer goods company or a consumer retail company, or subgroups of experts who can render an opinion on more sophisticated new companies or more sophisticated new technologies. So our philosophy is that absolutely the crowd is going to end up voting with dollars, but we think we can play a role in helping the crowd to learn quickly about a deal, and to basically to act as the hub for collecting intelligence, right? So we think that the collective intelligence of the crowd, the collective experience of the crowd, will be very, very powerful and very impactful when it comes to making decisions. And so if we, let's imagine that we are looking at a particular company and we have 1,000 people in the network that have either experience from an executive standpoint, from an academic standpoint, from a scientific standpoint, having access to 1,000 of those people, even if only 50 were to participate in a given analysis of a company, no other sort of bricks and mortar firm around the world would be able to compete by having all those people sort of on staff. And if you play that out, beyond 1,000 into sort of tens of thousands of people who are willing to, work and cooperate on a network, then you come up with a value proposition that is a whole new way of analyzing opportunities, recognizing opportunities, and acting on those opportunities. And that's where we're going to lead. We are leading the platform, and that's where we think OurCrowd will differentiate itself. And if we use, I'd like to use just Israel as a case study for a second. It's the type of opportunities that people will have, made available to them that is going to be very different from what we've seen in the past. And so let's use we've all heard about the BRIC countries, right? You have Brazil, Russia, India, and China, and you've been hearing about them for probably most of the last 20 years. However, if you ask most investors, did you ever get an opportunity to really invest directly in those countries, or were you shown any sort of direct opportunities? Most people would tell you that they had exposures through some sort of mutual fund, and so that would be after companies went public, but they very rarely had an opportunity to invest directly in very dynamic markets, and particularly in early stage opportunities. And so if we use Israel as an example, and we look at all of the large corporations who understand what I'm saying and have gone into Israel and made at least one investment. All these companies have made at least one investment in Israel in the last 10 years. Some of them have made a dozen or more investments in the last 10 years. And I'd ask you a simple question. When is the last time that someone, gave you an opportunity to invest in the type of companies that all of these large corporations have invested in, at the terms that they've invested in, and at the timing that they were shown those investments. These companies are able to sort of come in, look at early stage opportunities, and frankly create a lot of value for probably the products that they're developing, but also for their shareholders. One of the things that should happen if crowdfunding truly takes off, which I believe it will, becomes a global platform, is that investors around the world should have the opportunities made available to them that a lot of these big corporations have made available to them, and frankly the advantages that these corporations have by being able to go in and invest early. But again, it's going to depend on which platform you're using, whether or not that platform helps you make good decisions, whether that platform helps you make the right choices, and so platforms do matter, and I think that's where OurCrowd is going to try to sort of differentiate itself. And so how we think about this is, when we think about how we're going to offer value to you as investors and value to the entrepreneurs who come onto the platform as well, is we think about the four main reasons that crowdfunding or crowdsourcing has taken off. People want to draw wisdom from the crowd. They want to get funding. They want to create, and they want things voted on, right? And what OurCrowd has done is built a model that basically brings all four of these things together. We can extract wisdom from the crowd. Clearly, we can fund, and we can, help take companies to the next level, and basically share opinions about the viability of a product, and even maybe a new product that a company that is funded through OurCrowd is thinking and wants to take out to the crowd for opinion's sake. And the basis of all of this is that we think this new wave of being able to fund opportunities democratizes wealth creation. The opportunity to invest in VC is no longer for folks who have at least $1 million, or is no longer for the big banks or for the big pension funds. You can actually see an opportunity early. Perhaps it's a friend you grew up with. Perhaps it's a colleague that you've always known would sort of do something special. And so it takes this opportunity to create wealth and democratizes it. And without going through all these key differentiators, we do think that having sort of the roots of the organization in Israel, which is the second most prolific community for startup companies, is a substantial differentiator for OurCrowd. We think the strong network that we have to generate deal flows, the partnerships we form with both the clients and the firms that fund through the platform, and engaging the crowd to sort of make those companies not only more recognized but more valuable, in the end, we think are all going to be differentiators. And while we are going to be investing with people who come on to the crowd, we will continue to do it with partners. We will bring them opportunities, and they will bring us opportunities. And all the firms you see listed here are companies that we've invested with in the past, who have partnered with us on specific opportunities. We've brought them opportunities. They've brought us opportunities. We think that'll continue to be the case, particularly as these firms realize that the crowd is a really, really powerful funding channel. And for those of you who are new to the OurCrowd site, these are the companies that we've funded already. 30 of them have had follow-on rounds, so almost half of them. And one of the first questions I had when I was looking at the opportunity to become a part of OurCrowd is, well, what kind of companies actually would fund through the crowd? And I can tell you that there are some absolutely amazing companies that we've been able to fund, opportunities that we brought to smaller investors that never would have seen these type of opportunities before. And frankly, I think it's just getting started. I think the fact that we've been able to, in such a short time, even bring this level of quality company to the marketplace for our clients to invest in is a great signal for the future. And I expect that on a platform like OurCrowd, you'll see 50+ companies funded a year. And they will be I think, of increasingly higher quality. And I think the reason for that is because the process will be a much better process for them to be able to fund. And I think the exposure that they'll get and the impact to their company of funding through the crowd is going to be substantial. So I hope I didn't take too much time in ripping through those slides. I know we don't have a ton of time left, Zach, but we can take any questions.
Great. Thank you for a great presentation, Anthony. As Anthony catches his breath, some questions have come through. If you do have a question, something Anthony touched on, we do have a handful of questions that came through, so I think timing-wise that's going to work very well. If you do have a question, please submit it through your GoToWebinar control panel. So going back to something you said initially, you were talking about the data, and you said something in your comments that North America has been kind of slow to digital, I guess, if you compare it to the rest of the world. We have one attendee ask, why do you think that's the case? Why has North America been slow to the game?
Well, I mean, I think if we're talking specifically about slow to
online finance,
move from an investment standpoint, online finance is because I think it's, Zach, where the bulk of our money is right now. I think only 1% of the millionaires in the United States are under the age of 35. I think the bulk of assets, if you look at people who have at least $1 million to invest in the United States, most of those people are near 70. And so, the assets are still in the hands of, folks that are not heavy users of online technology, and particularly online finance. And so I think it's inertia. I think that where the money is, and I think that's what's lulling to sleep the financial services industry, is that they're looking at that and maybe reading the wrong thing into it. There's $40 trillion that's expected to change hands over the next 25 years in wealth transfer from one generation to the next. The next generation is going to have a whole different attitude of how they move money around online and how they invest online. But I think it's because of where the money rests right now, Zach.
Got it. Another question about, I guess, the ultra high net worth. This is something you obviously have a lot of experience with. So somebody asks, within the world of accredited investors, do you have any thoughts about the range of needs and interests concerning those who fall into the mass affluent world versus those who are ultra high net worth, say 10 to 20 million and up? Like, how do they approach fees, expenses, those kinds of things? Like, is it a different type of investor, I guess?
Well, so I mean, if we look at a very, if we look just on the investment side, I would say that their need to have a diversified portfolio is similar. Can someone with a higher net worth take on a little bit? Can they take on more risk in a portfolio? I guess generally yes. I mean, are they able to put money into assets that can be illiquid or tied up for longer periods? Sure. But if we just look at a portfolio from a portfolio construction standpoint, the risk-return aspects of that portfolio, should have the same considerations. I mean, whether you're somebody with $100,000 or $100 million, you're going to say to yourself, am I going to be able to outperform, the benchmarks. And all I'm saying is that even for that $100,000 investor, maybe they won't be able to put as big a piece of their assets into alternatives because of the illiquidity part of it. Although I think that's going to change, as I described earlier, as I think more and more secondary markets spring up for these alternative asset classes. But they still should have some exposure to it. And one of the benefits I see of this platform, and particularly our platform, Zach, is that you are able to invest the same terms of not only those partners I listed, but the person investing $1 million on the platform. You're really investing at the same terms as those people. And so one of the things that this whole crowdfunding and crowdsourcing is going to enable is that there's going to be the purchasing power of the crowd, right? So even though you put $10,000 in a particular investment, you've got the negotiating power, and you're getting the same term sheet of the entire, let's say, $5, $10, $20 million that may be invested in a specific deal. And so the crowd comes together, and as a group, they have a lot of leverage, and therefore can also have leverage on pricing, not just to gain opportunities, but also leverage on pricing.
So, in the remaining time we have a few investors. It's interesting in the comment section. There's a lot of excitement about some of the things you said about using the wisdom of the crowds to source new deals. One investor even saying, "Oh boy, you're going to open up, floodgates, especially with Jewish investors. You're going to get a lot of opinions you may not be ready for." But all joking aside, I mean, I think that's something that kind of is resonating with the audience here. Can you give a little bit of color, even at a high level, how you see that sort of going down?
Yeah, I mean, when I had my sort of first meeting with some of the partners at OurCrowd, I said I'm interested in doing this, is if we can not only we can go out there and claim we can do it faster. We can go out there and we can claim that we're going to give access to opportunity to people who never had this sort of opportunity before to invest in an asset class they never had before, and that's actually that would maybe be good on its own, and we can certainly create a business doing that. But for me, we had to not only be able to do it faster, we had to be able to do it better, and that's where the crowd comes in, because we can do it better if we are really intelligent about harnessing the power of the crowd. And there's probably various degrees or varying degrees of experience with sort of crowd. I grew up on Wall Street, and you're taught to be sort of a contrarian. Wherever the crowd is going, you go the opposite way. That is generally true if the crowd is talking to one another. If the crowd is decentralized and thinking on their own, and really aren't connected other than the fact that they have the same information to analyze, the crowd becomes extraordinarily powerful. And so if we build a platform where the crowd can help us identify opportunities, right, and also act on those opportunities, it will be an unmatched power and an unmatched capability. And I think that's going to be a cornerstone, of what we do. I mean, imagine if we have people from all parts of the globe who are saying, hey, you know what, you ought to be looking at companies in this sort of an industry, or you ought to be looking at maybe even a specific company, and it's coming from different parts of the globe, and it ends up being the same company that is getting referred to us, or it's the same sort of idea or the same need that's being identified. I think we're going to be able to identify the type of companies to invest in, companies themselves to invest in, and then to make decisions in not only a faster way but better way. So faster doesn't excite me that much if it's not better. And I'm here because I think we can do this faster and better.
Great. Couple questions in the remaining time that we have left. One investor said, during the course of your presentation, Anthony, you mentioned that crowdfunding will be an important part of any individual's portfolio, and said, in fact, you envision this as being a core part at some point. But you said the returns were likely to be lower than the returns of other asset classes. Why do you believe that to be true?
Not returns of other asset classes. I just think that the returns overall in all asset classes are going to be lower with the risk-free rate at zero.
Yep.
I just think that people have to moderate their expectations. I absolutely believe that VC and private equity will continue to have an edge over public market equity. I just think that all the returns are going to be shifted, shifted down. So I still think they'll have an advantage over other asset classes. It's just that I think we all have to, realize that, with the risk-free rate at zero, we're probably not going to be seeing double-digit returns in the broad equity or the broad capital markets. But I still think that the private capital markets will offer an advantage, and I think because of how secondary markets are evolving, and because of, again, I'll use the Uber example. I mean, we're seeing that people feel like they have enough information to act on that information way before companies go public, because of what they can learn about the company, what they can understand about the opportunity. And so I don't think that VC and private equity will be returning less than other asset classes. I just think that overall we've got to moderate our expectations for returns in general.
Fair enough. In the remaining time, I think we have time for one more question. Here's a follow-up question. We spoke about sort of the differences between, say, an accredited investor and an ultra-high net worth. As you think about growing OurCrowd, and you think about reaching out to sort of that ultra-high net worth audience, how do you envision fees playing into the sort of ecosystem? Is there a different product there? Is there a different service there?
I think a lot of this, Zach, we're gonna learn as we go along. I think, fees in general have been under pressure on Wall Street for a long time, and they will continue to be under pressure. I think what will happen is that, fees are going to just increasingly be more and more tied to value delivered and performance delivered. And I think that one of the nice things about this model is that good pricing won't be available to just the big investors, because the crowd itself will be seen as a big investor. And so you'll be the crowd will be able to negotiate, if you will, with the biggest investors. And so I think you'll start to see the pricing for certain asset classes, once we play this out, for the next 5 or 10 years, is going to be very similar for big investors, ultra high net worth investors, and the accredited investors. I think the exciting thing to me about this is that they can have access to the same opportunity, because the cost of delivering the opportunity just becomes much more efficient. And I think even the ultra high net worth investors will realize that, and are increasingly realizing that they sort of can't wait necessarily for someone to show them even a private equity opportunity or a private equity fund. That the crowd is just going to be very good at finding opportunities. Before, if Wall Street doesn't change its ways, the crowd's just going to sniff out these things sooner and faster. And if you're not there investing, with the crowd at those earlier stages, it's not that you won't be able to invest, but you're just, a lot of the value may already have been realized by the time anybody shows it to you. And so I think even if you're a really big investor, if you're not doing it yourself, you're going to want to know that advisors you have it on their radar screen to look for opportunities for you at an earlier stage. And that's where I think that, for me, this is really exciting, because it's, the crowd has an opportunity to identify value, act on that value, and realize value in a way that they've never been able to do before. It fits right in line with all the trends and all the themes we're seeing. It's a very empowering development, and it's something I think it's why investors are embracing it the way they are. It puts a lot of power in their hands. It engages them, and it allows them to see stuff at a very, very early stage. But I have to preface all of that with, of course, the risks that go along with it. I mean, it's still venture capital. It's still private equity type investments, and all the associated risks, still need to be understood.
Anthony DeChellis, I think that's all the time we have for tonight. Thank you very much for a very lively conversation. That was great.
Thank you, Zach. I appreciate it.
Thank you, everyone else who tuned in from around the world. I see a lot of investors on the list, and I've seen a lot of new names there as well. We didn't have time to get through. There are another 1 or 2 questions out there. If you want to follow up with us, we'd be happy to answer some of those questions offline. There was a question about sort of emerging markets, Anthony. Maybe we can address that elsewhere.
What was the emerging market question?
Specifically about Africa. I think we try to hold to the hour time limit, but basically
we can send a note back.
Yeah, we'll follow up offline. Again, people are welcoming you on board. They're excited to see what OurCrowd has in store. We did record this event, and we have Anthony's slides. We'll send out a link tomorrow where you can access both of those things. Again, we do these events. Hopefully these are useful for the audience. If you have questions and want some more feedback, you want to engage with us, we're always available as well. I'm Zach Miller here at OurCrowd. You just heard from Anthony DeChellis, our new president, and thank you for joining us.